Good afternoon. This is Tom Alexander. It is Saturday, March 16th, and this is the weekend update that I do every single week. You can find this update here. I'll show you. You can find this update as well as other updates. If you go to alexandertrading.com, this is the website. Click on weekly update. This is free. And then this is the weekend update for last weekend. I don't have this weekend's posted yet. I will by the time you're seeing this. The update for this weekend will be here. You can scroll through. You can see what I said at the end of each week prior to the next week's trade, and you can judge for yourself if you find value in that. Now, I would very much appreciate it if you're finding value in these reports that you like and subscribe. If you make comments, that's great. All of this helps the magic algorithm as I try to grow my channel. So let's talk about the market a little bit here. We have been in, I'm going to switch over here. We have been in this extraordinary rally off the October 2023 lows. And it's been extraordinary in terms of price magnitude, but more what is really extraordinary about it, because we have had rallies of this magnitude multiple times, especially in bull markets and in bull legs. But what is unique about this particular rally so far is and I'm talking about the SPX here. It's a little bit different in the other indices. You've had a little bit deeper retracements in the other indices than you have the SPX, even though even in those three, the retracements have been both shallow and short-lived. But in the SPX, it's just been unbelievable. The deepest rally retracement we've had in the SPX from print high to print low has been about 2.53%, and that was complete in 9 trade hours. So that's a rate of change that cannot continue. The rate of change has already slowed this year, and it began slowing after the very brief retracement at the beginning of the year. And since then, we're certainly in a well-defined uptrend, but it's become more, there have been some dips in it. Now, it's the depth of the dips that has been remarkable. We are in this incredible pattern of dip and rip. Well, is it going to continue into next week since we've had what could be considered a dip? Are we going to rip again? Well, we'll find out. But at some point this year, this is an election year also, and I posted this in the written report that you all should have received. If you're not receiving those free reports, written reports, go to the website, shoot me an email, tom@alexandertrading.com, and I'll put you on the free report list. But in that report, I go back to 1980 and show the retracements in those years, in election years. We are in an election year, and I don't think anyone would be surprised if we don't have one of the most contentious elections in U.S. history, which is saying something. And so far, the market is going no big deal. I don't think that's going to continue, even if we are up strongly for the year, and that would not surprise me at all. What would shock me is if we don't have more than a 2.5% retracement, and that's from print high to print low. From close to close, I don't think we've had a 2% retracement. So I don't think that's going to continue. Now, I'm not in the business. I am a trader. I'm not in the business of trying to predict exact market turns up or down. But the reward to risk to the upside in this market, to me, is increasingly questionable until we get some sort of semblance of at least short-term extreme in terms of technical readings, a 3, 4, 5% plus retracement, et cetera. So I'm very suspicious of upside, but I don't want to get run over either. I was suspicious of upside at the end of January, and you can see where we are now. But that's a trading issue. And my advice is to always follow price action. So what has to happen to indicate something is developing more to the downside than anything that we've seen? Well, for one thing, you have to take out downside levels. Now, how do I determine downside levels? I determine downside levels entirely through an auction market lens, meaning what has actually previously occurred between buyers and sellers. What have buyers and sellers themselves determined as important levels? I'm not into the magic number game. If magic numbers work, you still have to have price action to confirm it. So why not just default to price action? It keeps things very simple. I try to simplify my trading. Okay, so the level to keep an eye on as we head into next week to the downside is near 50.91. That is sort of a ledge of two previous lows. And more importantly than 50.91 is this 50.57 level, because below 50.57, you're in an elevator shaft that extends all the way down to the low of February 22nd. You have this giant gap here. You really have absolutely nothing from an auction market perspective until you get really down into here. So this is that's not a forecast. It's just something I would be keeping an eye on if we do get a healthy correction over the next week or so into this area. It's probably a buying opportunity. Now, to the upside, this is the immediate upper key reference area, i.e. potential resistance. It is an inflection point. I don't think if we do revisit this area, you will stay here for long. I think if we do revisit this area, you're going to see an acceleration higher relatively soon, or you're going to get another rejection. And in which case, then there are numerous scenarios. We could form some sort of balance with very little price retracement, et cetera. So, but that's what has to happen immediately to suggest that we're having something more to the downside than we've seen to this point in time since October 2023 lows, is for a close below 50.91 to occur. Let's look at the other stuff here. We'll go to the NDX. Now, the NDX sort of stuck its toes below the most critical level. It managed to eke out a close just above the 17,793 level. So for that reason, heading into Globex on Sunday night, and then the cash session on Monday morning. This is the cash session low that's going to be important. Below here, you're in an elevator shaft down to 17,319. Back to the upside, it's the highs. Now, next week we have the NVIDIA conference, and we have Jerome Powell speaking, and the Fed announcement, and the discussion regarding Fed policy and interest rate cuts and dot plots and all of this stuff on Wednesday. Factor that into your trading. I don't know how directional things will be into those events, as in particular the Fed meeting. Now, the NVIDIA conference, you have Jensen Huang speaking on Monday, at least Monday, maybe even more than that, but he could also move the market as well. But I think any sort of sustained move is likely going to occur beginning maybe later Wednesday afternoon after the dust from the Fed speak settles. Now, if we could easily retrace from here back towards this level, that would not invalidate ultimately breaking these lower levels and then perhaps trading lower. So, all right, let's look at the Dow, and then we'll go to the Russell. The Dow is between levels. Here they are, and again, these charts are available on the website. They are available in the PDF that you can download from the website. So if you want these levels, you can go to the website and pick them up. But here are the levels for the Dow, and then the Russell, which is sort of its own animal. Here you go. Now, this is a pretty significant selling tail in the middle of nowhere that occurred. But I would be, based on this, I would be favoring shorts in the Russell, regardless of any short-term bounce. Okay, let's take a look at the profile view of the S&P. Now, I've been showing this, I typically show it every week, and I've been talking for months about how extraordinarily vertical this market was off of the October low, unusually vertical. And I also have been pounding the table that that would not continue, the rate of change was slow, and it has. The March profile view is reflecting that. The March trade so far has been choppy, overlapping, and it's formed more of this Gaussian looking shape than either the February or the January or the December. You know, if we go back quarterly, you can I've broken this down both monthly and quarterly over the past few weeks. You can go back and check those out in previous weekend updates. This is where we closed on Friday, right at the low extreme of the high volume node of this structure. Now, what I expect to see before the end of March is either the low or the high to be extended. So we'll check that out. Okay, if we look at the technical situation of the market, what you see here, this is NYSE data. The red line is a 10 period, in this case day, since this is a daily chart, 10 period moving average of NYSE advancing issues. The green is a 5 period moving average of NYSE advancing issues, and the blue histogram is closing breadth. Now, what has been unusual about breadth since the middle of February has been the extraordinarily narrow range in which you just traded both up and down. And you've had very, very little conviction either up or down in the internals. Now, on Thursday, we saw the biggest decline, closing breadth, the largest, the most negative, is what I'm trying to say, closing breadth reading in NYSE breadth that we've seen since the end of February. Now, that marked a low. And bull trends, you're starting to look for a low here. So this is reason to not be surprised by some rally attempt early next week. If we don't get that rally attempt and we have another really wide range down day on negative breadth, and that cements the idea that we're in the process of correcting this market to a greater degree, both in price and potentially time, than any period that we've seen since the bull trend began last October. Okay, guys, I hope you found this helpful. Again, if you find value in this, please like it, please subscribe, check out the website. Have a great weekend. I'll speak with you again very soon.